Welcome to the Money and Markets podcast with me, Kudzi Sharara. So the Money and Markets podcast try to break down those issues to do with the Zimbabwean economy, to do with our markets, and make sure that you understand the reasons behind certain decisions and you stay informed. And today is a special podcast where we have Tafara Mtutu from Morgan & Co. They've recently released their 2025 economic outlook and equity strategy. And today he's going to help us break down that report to try and get the reasons behind some of the predictions and projections that they gave as Morgan & Co. Tafara, welcome to the Money and Markets podcast.
Hi, Kudzi, and thank you for having me.
Thank you. Let's get straight into it. I know Morgan & Co. is one of those. I think in the last couple of years on the Capital Markets Awards, you guys have been consistent and they've been one of the top research stock-breaking firm in the Zimbabwean market. And I would just want to congratulate you for that.
Thank you. And right back for the award.
Thank you. Now let's get into this economic outlook and equity strategy for 2025. You recently released the report. Let's start at the top, just looking at the general economic outlook, where obviously the government is projecting a 6% GDP growth. And yesterday I heard the minister insisting that they are still looking at that 6% growth. However, you guys had a 5.5% growth. What are the key differences underlying these assumptions?
I think it stems from two major issues. One of them being the unevenly distributed rains that we've seen throughout this rainy season. I think last year people were expecting a bit more rain in December, and it was a bit spotty. And there were some people who had planted early that saw that had to replant again this year. And then this month we're seeing some heavy rains concentrated in some places in Zimbabwe, and we think those rains could actually destroy some crops and also impact the overall harvest that's expected in the 2024-2025 agriculture season. So I think there are going to be some losses in the agriculture sector, and I think that will pull down the growth forecast from 6%. We also think that the economy has sort of been grounded to somewhat a halt because of the tight monetary policy in the country. When money is not moving, businesses struggle, and we have seen a lot of those struggling in recent weeks. So I think that will also be another source of, the lower forecast that we have as Morgan & Co.
Interesting. And for those who might not know, Zimbabwe is currently experiencing heavy rains as we speak. I think we saw in Mutare yesterday, and I also saw some videos from Hwange and Chirezi. And as we speak, it has started to rain again, even in Harare, and my laptop is showing me that expecting heavy rains. So yeah, that could also become negative if it results in floods. What else? What other headwinds do you foresee going into 2025?
So in our report, we mentioned those two as one of the key headwinds, but there are many other headwinds in Zimbabwe. It's just that we did not focus on those because they don't fall in the category of economic. Some are more social than economic, some are political than economic. So some of those issues relate to political uncertainty. We're seeing there's a lot of talk around politics in Zimbabwe. And I think that it some economic activity or even foreign direct investments, which Zimbabwe critically needs. We're also seeing issues to do with Zimbabwe being locked out of international capital or international money. This is one thing that a lot of countries, especially in Africa, some countries that are doing very well, they've got access to this funding, IMF, World Bank. those sort of institutions, they have access to that, but Zimbabwe is still cut out from those institutions. And I think that would be, another source of pain for Zimbabwe, because we do need that source of capital to smoothen things out in this economy. Then moving on to what more social than economic is the brain drain that we're seeing in Zimbabwe. We've seen a lot of people moving out of the country in search of greener pastures. We'll talk about that later in terms of how it has been positively in diaspora remittances, but we're still seeing that the brain drain is affecting local economic activity and productivity.
Now, Zimbabwe continues to have a current account surplus, and in your report, you also mentioned that. Could you elaborate on the factors contributing to this surplus, and how sustainable do you consider? What are the main risks that could prevent this surplus from continuously materializing?
Okay, so the current account surplus that we're seeing, it stems mainly from a trade surplus that we're forecasting. At the moment, this year, it will be a very narrow deficit from our estimates, but we're thinking, and that is really driven by there's been a surge in currency outflows in the country, or service payments, according to the RBZ. But going forward, I think we're still going to see strong receipt figures from the gold sector in 2025. We also see sustained or elevated receipts from the agriculture sector, especially tobacco, regardless of some of the shocks that we're expecting from La Niña. And those two combined, I think the receipts that we're going to get from that, and we add on to we add the diaspora remittances on top of that. I think those receipts in total, I think they're likely going to outweigh the foreign currency payments that we're going to see in Zimbabwe, mainly because one, Zimbabwe has been, the grain imports that we saw last year because of El Nino were quite high, and we think that trend is going to reverse because we will have more local output in 2025. So I think from that perspective, we could see imports falling compared to exports. We also see energy imports also falling away because with La Niña, we're going to see flows coming in through Zambezi River and Kariba, and that will be a good thing for our local energy production capacity. And I think that end will likely see an ease in terms of energy imports. So I think that will also support the case for a current account surplus in 2025. So we do that a possibility.
Interesting. Let's move to the monetary policy front. The Reserve Bank of Zimbabwe has, in the last couple of months, maybe a year now, running through what they're calling a tight monetary policy, and we've seen its impact. And this policy, which high interest rates above 35%, and also higher reserve ratios. It's aimed at currency stability, and it's what are your thoughts on this the trade-off between stability and economic growth?
So the tight monetary policy has done well in terms of containing the parallel market and as well as the exchange rates gap. I think in the last 2 or 3 months, we've seen the exchange rate being flattening between, I'd say, 36 and 40 to the dollar. But in my opinion, I think this is not sustainable because ideally what you want is to have money flowing in the economy with stability in the exchange rate. But what we're seeing here is monetary policies are holding off or tightening the liquidity supply in the country and affecting trade, free trade in terms of goods and services, as well as the exchange of currencies. And I think the moment you lift that lead, which I think will happen soon, because more and more companies are going into corporate rescue because there just isn't enough money for working capital. When they lift the lead because they need to support businesses, I think some of those funds are going to find their way to the parallel market, and I think we're going to see a bit of a jolt in the parallel market. So the stability that we're seeing, it's good, but I don't see it being sustainable, because I think there's still some underlying fundamental corrections done. And just
maybe on that, Tafara, we want growth, but we also want stability. How would you suggest governments strikes a balancing act in terms of making sure that we have that growth, but we also don't have that price and the currency instability?
I think we can still have growth. I think the key issue is to really make sure that we address this issue of currency once and for all. Having multiple currencies in Zimbabwe, I think that's one of the headaches that, if we fail to manage it properly, we can see this sort of issues coming into play. Arbitrage is coming into play, and we are seeing people who, in my opinion, they don't want to see stability in currency markets, because then they want to make an additional buck on the side. So I think if we address this currency issue in a sustainable way, without having to encounter this currency challenge, we tend to affect other businesses along the way. So having one currency, I think, would be good. The cards are still out on which currency should be the one, but I think it's a matter of time, and I think some solid work from the monetary and fiscal policy will be key in that.
Thank you. Earlier on, we spoke about briefly about the agricultural sector and the impact that it has on the economy. So while normal to above normal rainfall is expected in the second half of the season, and we are seeing it now, your report maintains high climate risk. What specific risks are you most concerned about, and what will be the potential impact on the agriculture output and overall GDP growth?
Okay, so when we did our food and agriculture sector report for the current agriculture season, we already noted that there are some risks associated with La Niña. So this phenomenon in climate and weather is usually associated with flooding. So while the rains come in and it's good for the agriculture, some areas will likely experience more rainfall than actually needed, and I think that could result in flooding or leaching. In some cases, I wouldn't want to get into more specifics, but too much rain towards the harvesting season of some crops like sugarcane, for example, that can affect the quality of the sugar, that will affect output and in turn exports for the crop. So those are the things that we are alluding to, and we're saying we are happy that the rains are, but if we get more than we actually need, it could start to affect quality and production and output.
You mentioned the sugar sector there. What are the sectors or subsectors of the agricultural sector that you think will be most affected, and how will this impact food security and agricultural exports?
So I think when it comes to exports, we're also looking at tobacco. Tobacco is quite a sensitive crop. If it doesn't dry well towards the harvesting part of the crop's maturity, we think that could affect the quality of the price that that tobacco farmers will get at the auction floors. We also think that if there's too much rain, that could actually destroy some of the maize crop that was planted towards the end of December and beginning of this year. So if there's flooding that affects the growth of those crops, then that could also affect the expected maize harvest later this year.
Let's move on to the fiscal front. Obviously, we saw the 2025 national budget coming through, and your report also touched on some of the taxation measures that were introduced. Maybe can you speak to us in terms of what sort of impact the current fiscal measures will have on economic growth going into 2025?
Okay, so I think one of the key things that came out from the latest budget statement was the need to widen the tax base. A lot of investors, analysts have called for the government to widen the tax base over increasing taxes, and we're seeing ZIMRA leaning towards that way. The tax collector has been quite aggressive with collecting money from economic agents that have been operating without paying taxes, so the informal sector mostly, and people that have been selling imported goods, illegally imported products. So we're seeing a crackdown by ZIMRA on those players. And we're also seeing them also trying to tax service providers that mainly operate in the informal market, and we are seeing all the tax collector also going after professionals that have been operating without tax numbers. So all these measures, I think, one, widening the tax base should ease the burden on formal tax players who have been, in my opinion, overtaxed over the years, and to some extent, some still do. So I think that is a welcome move, because a lot of formal players, and that formal player, that base has been shrinking over the years. I think it's time that they widen the tax base and ease the burden so that a lot of people chip in actually maintaining the coffers with the government.
Now, let's look at the local currency and obviously the policies around it. The report mentions the settlement of outstanding obligations by government through a combination of the local currency ZiG as well as USD, but mostly with the bias towards the latter. What are the implications of this bias for the local currency for overall macroeconomic stability?
Okay, so let me just a step before I respond to that. Government has a lot of obligations to foot coming from 2024, mainly, the government contractors that did the roads and the infrastructure works, and they've alluded to issuing treasury bills to sort of cover that without having to fork out more money in the name of stability. While that's welcome, I think government or whoever was contracted, they cannot then pay the bills or address working capital gaps with treasury bills. So I think there's still a need to actually have some sort of monetary exchange to address working capital gaps. And that's why in our report, we think that government will still need at some point to give out some sort of payment to these to fulfill these obligations, but we think that it will be mostly in USD, considering that foreign currency inflows could be better this year. We think they will be prompted to go towards more USD than ZiG, because we're also seeing that if the monetary and fiscal policymakers are going to speak the same language of stability, I think they're going to have to limit ZiG currency flows, and that's why we're saying most of those payments, if they're going to be done this year, most of them will have to be USD.
And how does that affect ZiG? We have the local currency in use, but obviously with limited use cases. And now that government will be paying more in US dollars, what does that say about the local currency?
I think they'll hold on because they still need to maintain stability. They need to limit supply of ZiG so that most of it does not find its way into the parallel market. But I think during this time, I think it will be an opportunity for monetary policymakers to put additional measures or add more, to push for confidence in the currency, such that by the time they need to add more ZiG into the system, it won't result in a in severe depreciation of the currency, especially in the parallel market. So I think right now should be time for them to build confidence in the currency, to continuously engage the market and give them confidence in that the currency that stays is completely backed by gold in the reserves.
One of the policies that the central bank that you have mentioned there is obviously a higher statutory reserves requirements. How do you see that evolving in 2025, and what impact will they have on credit availability and economic activity? Recently, we saw the Reserve Bank introducing the trade finance facility that is meant to oil the economy, but we also know that at the same time there are higher reserve ratios policy that is there. How do you see that evolving in 2025?
I think they will need to lower the reserve ratio requirements a bit to open up liquidity for businesses. I think they are realizing now that the hold on ZiG is quite extensive and it's actually affecting operations, and they need to give these businesses some breathing room. So I think they'll need to lower these reserve requirements. But I think when you put in that TFF into play, you get this picture where they are appreciating the need for liquidity in the economy, but they want to put more stringent measures to make sure that whatever dollar is put out, whatever ZiG is put out, is exclusively going into productive operations, and there is no excess that will find its way into the informal market. So I think that's why we think they'll lower their reserve ratio requirement, specifically to facilitate the implementation of the TFF, and also to make sure that those funds exclusively go into productive companies, and that those companies do not misuse those funds by either by pushing those funds into the parallel market.
Now, the Zimbabwean economy, Tafara, depends a lot on gold sector, gold exports, as well as remittances coming into the country. What are your projections going into 2025? We just hit the record levels in terms of gold deliveries to Fidelity refiners, as well as remittances have also been significantly growing. What's your outlook like for 2025?
So for gold, we're seeing output probably slowing a bit in the first quarter because of the floods that have been affecting underground mining. But going forward, I think we'll still see some good results. The mining industry, the ministry is expecting 40 tons at least this year. I think the incentives in place could support such a number. We're also seeing the gold price coming in as a very strong incentivizing factor as well. The current dynamics in the gold price globally, I think they support prices of gold even going to as high as 3,000. So I think that is enough to incentivize, especially the small scale miners, to ramp up production this year. So I think for in terms of gold, I think we could have another record year in 2025. And then when you look at international diaspora remittances, there's this issue of more and more people moving out of the country in search of greener pastures. And I think that trend is going to continue in 2025, mostly because globally in developed markets, we are seeing interest rates falling off. And I think that will encourage more and more businesses to actually increase production, because the required rate of return has gone down. It makes a lot of projects that have been shelved now feasible. So now I think we could see more and more companies out there engaging in more projects, because it's now affordable from a debt funding perspective. And I think we could start to see some of these companies also employing people from countries like Zimbabwe as they ramp up those projects.
Now, Tafara, Morgan & Co. is obviously a stockbroking firm, and now want to move on to capital markets and obviously the equity strategy that you have put out. Well, let's start with on this. What do you expect going into 2025? Looking at the VFX maybe first. How do you see things panning out on the VFX, and then obviously on the ZSE?
So 2024 VFX was largely affected by liquidity. I think there just wasn't enough foreign currency to support the exchange. And this is over and above issues to do with confidence in formal banking channels or formal financial services channels. So I think from that perspective, there was issues. That's why the VFX struggled. But that said, we saw some record trades being done, especially late last year, and slowly activity is picking up. And I think in 2025, because of the foreign currency, the positive inflows that we're expecting, I think there could be some change on the VFX. And I think that could really benefit, especially the very liquid stocks like your Simbisas and your Inscos. I think those could do well this year. But the issue why we're not very bullish on VFX is that they operate on a currency that is which is what companies out there really need. So when a company earns money, if it's in USD, the first call is to put it back into working capital so that they can get more money. But if it's ZIG, you could see some companies saying, look, let's just put it into the capital markets because we don't have much use for it in our operations. So that difference in the economy could affect VFX negatively in 2025. And then when you move on to the ZSE, we expect that it will remain volatile. Talking about a company having solid fundamentals, we're looking at a balance sheet with what can I say, a reasonable current ratio, which talks to solvency risk. A good current ratio means there's low solvency risk. So in essence, we have a strong balance sheet that will support operations. So to that end, we're also talking about companies that are not exposed to debt, especially ZIG debt, or companies that don't depend on debt because they have operations that are sufficiently generating cash flows needed to run the business. And then we're also looking at the quality of earnings or cash flows. So a company that's earning more in ZIG could be more at risk compared to a company that earns most of its currency in USD. That's the other thing. And then we also look at how defensive are the operations of the business. So we would rather go for companies that operate or that sell products and services that people will still need, whether Zimbabwe is having a good year or a bad year. So defensive products, food, alcohol, airtime, data services, those sort of things. Those are the things that we think will also help in making a case for a company being regarded as having solid fundamentals. And then we also look at management. Is management doing a good job in terms of weathering the storms that we're seeing in the economic environment? And then I think we could also look at a company's ability to also give back to its shareholders through dividends without actually affecting the operations of the business. So I think all these factors come into play and they make a case for, whether business has or not.
Now, one sector that has got quite a number of listings is the banking sector. You've got quite a number of companies that are listed. You've got your CPZ, your ZB, your NMB. EcoCash is basically Stewart Bank, and then you also have First Capital Bank. But in your report, you considered the sector underweight, despite the anticipated increase in consumer demand. What are the specific risks that are associated with the banking sector's exposure to the local currency or to the Zimbabwean economy?
I think it mostly goes back to the tight policy that we're seeing. In as much as banks don't carry the risk of holding the money, I mean, they just get deposits and they push them out as loans. I think lending income in 2025 could be, I think it could be constrained. The high interest rates, I think, could deter companies from taking more debt. And the high reserve ratio requirements will actually limit how much they can push out through loans. The time that they're giving people to pay back the monies that they're loaning out through the targeted finance facility, which is about 9 months. I think it's quite punitive for businesses, and I don't think if they will take it. I think they would rather opt for USD lending, and I think it would probably benefit businesses that are leveraging off international credit lines. So the banking sector being a sector that typically depends on lending income, I don't think that would be the key driver of income this year. But I think if they can leverage off the high velocity of money that we've observed over the years, I think they can make money through non-interest income in terms of fees and commissions and activities relating to allocating foreign currency to productive players in the economy.
Thank you, Tafara. Now, without disclosing much, obviously, I would want people to go and look out for your report and read that particular report. But maybe just going through your stock picking universe, maybe what sort of aspects of the report or company specific reports that people, what sort of information are they likely to find in your report on particular companies? What exactly are you covering? I know you've got your deltas, your economics in that report, but what are you covering? What can potential readers of this report see in that?
So in our university, we've tried to trim it down to companies that we've noticed have generated a lot of investor interest. Companies that are fairly liquid, companies that could actually pique the interest of institutional investors. And we've also added in the companies that have come to be of interest to high net worth individuals. So any of those people, institutional investors, high net worth investors, I think they could find some stocks that would be of interest to them in our universe, because we have tailored that universe to such people. We have steered clear away from very illiquid stocks or small cap stocks, in as much as they offer quite a high return, as we have noticed over the years. The trade flows sometimes just do not justify an investment in such stocks. So we wouldn't want any investor that reads our report to go into stocks that will affect their return, especially when they encounter liquidity risk. So from that perspective, we are looking at mainly large and middle cap stocks, companies that we think have got a case, companies that we think will continue to operating regardless of what's happening in Zimbabwe. And even though the calls are quite different, some have buys, sells, hold. When we say it's a sell, we are not saying it's a bad company. We are just saying that the price that justifies that's justified by the fundamentals of the business is lower than the current price in the market. We are not saying anything bad about the company. It's just saying there's a mismatch between the current price and the fundamentals of the business. That's all.
There you have it. That was Tafara Mtutu with Morgan & Co. Just breaking down their latest report on the 2025 outlook, as well as the equity strategy. Tafara, thank you for taking your time to be with us.
It's a pleasure, Kuzi. Thank you for having me.
We'll be posting this on our YouTube channel at Kudzi Sharara channel. You can also find links on my Twitter handle at Kudzi_Sharara. Also on my Facebook page, you also see. I'm sure Morgan and Cole will also be sharing this link on their platforms. You can also follow them for that report. They are on LinkedIn. They are on Twitter.